You saw the downtrend slowing, you watched the momentum fade, and then the market explodes upward, leaving you completely behind. You knew the bear market was exhausting itself, so why didn't you pull the trigger when the price finally reversed? It happens to intermediate traders every day. You understand the theory behind liquidity and support levels, but when a live market actually shifts gears, that theoretical knowledge dissolves into hesitation. Analysis paralysis takes over. To strip that hesitation out of your process, we have to look at a specific protocol called the Institutional Order Flow Entry Drill, or IOFED. This protocol operates differently. It refuses to rely on laggy indicators guessing the future. Instead, it provides a strict, mechanical checklist built to track the exact footprints of smart money. By following a rigid set of structural rules, you stop guessing. You convert abstract market theory into surgical, high-probability execution. Let's rewind the chart and look at the quiet moments right before that explosive rally took off. Before a massive move begins, institutions often drive the price below a recent low. This deliberately triggers the stop losses of retail traders, sweeping up enough liquidity to fuel the actual intended position. This chart maps out the prerequisite for an entry. Once that liquidity is swept, we need to see a market structure shift. The price violently reverse, defined here by this horizontal line. Look closely at the actual candlesticks during that breakout. Notice these 3 massive consecutive green candles smashing through our threshold. This energetic movement is called displacement. It proves that heavy institutional capital is actively driving the price. Without that aggressive speed and size, any trade is a gamble. When you identify clear displacement, the candles themselves reveal where institutional capital has shifted the market's momentum. At this stage, amateur traders buy out of FOMO. Professionals sit on their hands. They never chase the initial breakout. They let the trap set, knowing the market has to retrace. To find out exactly where that retracement will land, this chart applies a Fibonacci tool, drawn directly from the absolute low of the move up to the swing high. This creates a specific pocket between the 62% and 79% retracement levels. This pocket is the optimal trade entry zone. Statistically, it is the most reliable area for a high-momentum market to catch its breath. Next, we look back inside the initial breakout leg. Because the price moved so fast, it left an empty space between the high of the first candle and the low of the third. This gap is a structural inefficiency known as a fair value gap. Notice the overlap. The fair value gap sits directly within that 62 to 79% retracement band. Aligning these 2 independent markers narrows your focus to a specific zone. It identifies where the market is most likely to rebalance before price continues in its new direction. Executing the trade now becomes purely mechanical. You place a limit order right at the boundary of that fair value gap, letting the market bring the entry to you. Your stop loss goes beneath the lowest point of the initial liquidity dip. If price falls below this red line, you take a small controlled loss. For the exit, we target an old structural peak, aiming for resting liquidity. Because our entry is deep within the retracement, our risk is incredibly tight, while our profit target stretches far above. This alignment guarantees a minimum risk-to-reward ratio of 1 to 3. The value of this framework lies in engineering an asymmetrical risk profile. You keep your potential losses small, stretch your potential wins, and ensure your long-term survival in the markets. There is a reason this protocol is called an entry drill. It requires zero intuition. It demands repetitive muscle memory until the pattern recognition becomes automatic. Applying it requires immense psychological restraint. You must sit quietly for hours, letting subpar setups pass by until every variable perfectly aligns. Trading at this level means accepting probability. Your objective is not to win every individual setup. Your objective is to execute a flawless statistical edge over hundreds of iterations. You can start building that muscle memory right now by using the institutional-grade charting tools and demo accounts on the FXNX platform. The market pays professionals for their patience. The institutional order flow entry drill is how you align your execution with the mechanics of the market.